Bollinger Band scalping. So what this technique is, very, very powerful. And what I love about this is it's based in actual statistics, actual math, not some ancient Phoenician numerology or astrology or even just some concept or theory that somebody came up with. No, this is based on actual statistics. And so this is what I like to trade. So let me just show it to you real quick. It's pretty simple. What we're using is our Bollinger Bands. Got price action. Okay, we've got a daily chart. We're looking at the euro right now. I'll show you an example on stocks as well. But the setup is very simple. So the setup is where we get an entire price bar above the upper Bollinger Band or below the lower Bollinger Band. We'll show an example of that as well. So what does that mean? That's the setup. Okay, so the setup, why that is so powerful statistically is because we are beyond 2 standard deviations of the mean, and that is not sustainable. And what I mean by that, in fact, first let me just show you here the settings on the Bollinger Bands, because this is very important. People usually ask about this anyway. And, well, you should, because especially with this setup, super important. So some people use a 14 length on the Bollinger Band, and that could be good for certain things, but for this trade setup, you want to use the 20. So 20 is the length, close is the source, and 2 standard deviations. Again, very, very important for this particular setup. So those are the settings. Now, let me show you why this is a statistical high probability trade, and it's based on math and not just theory. So here's our good old-fashioned probability bell curve. And you can see on the probability bell curve, here's our mean. That's where most price action occurs, most of anything, right? This is a ubiquitous type of probability diagram. Now, what we want is we want to look for 2 standard deviations away from the mean. And that's what the Bollinger Band did for us, right? We had that set to 2 standard deviations over 20 periods. And look what we've got here. So once we get beyond 2 standard deviations, well, what are the probabilities of it continuing to go in that direction? So only 2.15% from 2 to 3, and after 3 standard deviations, I mean, it's getting pretty close to 0 there. So if we add that up, we've got, well, let's just round it up and just say you got 2.5. Okay, I'm going to fudge on it a little bit and make it a little worse than it is. But we got 2.5% chance of the market continuing to go in the same direction. And the same would be for the opposite side, of course, as well. So that's why I call these the money zones. These are the money zones, above or below 2 standard deviations. Okay, so let's go back to our charts now that we understand the statistics behind this. Here's another example. I promised we'd look at a stock, so we're looking at Apple right now. And this is also can be a little bit counterintuitive. So it looks like we might have a Bollinger Band squeeze here. Let me change the scaling here. So some people would see this as a Bollinger Band squeeze, and they would want to take this long. But here's the real deal, is once we get up here, oh, we went up too far too fast, and we went beyond the 2 standard deviations with the open and the close, the real body of those candles. And it's not statistically sustainable. And remember, this is just scalping trade, so here is literally the 20 moving average is your mean, and it comes back to the mean. So we scalp this puppy back down here. Now, having said all of that, this is great, but there's one more aspect of this that is absolutely critical. Remember, as I'm famous for saying, the dollars are in the details. So the statistical structure of the price is not enough. So you've got price structure, such as this would be, I call this a Bollinger Band exhaustion price structure, but you can get head and shoulders, double tops, wedges, triangles, all these things. Okay, those are price structures, but you can't trade those in and of themselves or by themselves. You have to add one more thing, and that one more thing is actually more important than price structure, and that thing is supply-demand shift. Because really all that makes prices go up is more demand than supply, and what makes prices come down is more supply than demand. So we have to add that to the equation here. Let me show you something interesting. Now, look at this example. So price came down, and we've got a bar that's below 2 standard deviations. All right, so that is definitely abnormal. But when do we look for this puppy to turn around? We got to wait for the shift of supply and demand. And that's what's going to do it. That provides us the timing. So I call this the setup, and then I wait for the trigger. All right, and the trigger comes here, and then this is the first time, we actually go back to the mean. Here we got close, but we didn't quite get to it. And then it comes back off of it and actually goes to the upper Bollinger Band. Sometimes these will turn into trend trades, and sometimes the risk reward on them is really, really good. Other times they're just little scalp trades. So, of course, now what do we use for a supply demand shift, since that is a requirement to add to this and any other chart pattern? And there's many different things you can use. Some people like to use time and sales. Some use level 3. Those can be very good if you're skilled with it. It takes time to get used to it and really get those patterns into your nervous system. That's a bit of a skill that has to be developed. I would say that's more advanced, more difficult. I personally, there's different indicators you can use. Volume, obviously. Again, volume is not as easy to read as most people think. So I use what I call my market timing indicator. And I'm happy to share that with you, by the way. I give it to all of my viewers for free, meaning you. And what's cool about this is it's very objective and rule-based. So there's no skill that has to be developed, such as in reading time and sales or level 3. It's just, well, it's a mathematical formula again. So it's math. And that means you'll get the same setups, the same patterns, the same triggers that I will, because, well, I type 2 plus 2 in my calculator, you do the same on yours, and we're both going to get 4 pretty much, I'm guessing, around 100% of the time. Anyway, I'll be happy to give that to you for free. It's a common indicator, just for full disclosure, but I modify it, and that's what turns it into a market timing indicator. And I show you how to set it up on your charts. I'll show you how to trade it, and all for free. And I show you why it works. Again, I'll show you the logic behind it. So that's all on a recorded webinar. Therefore, go check that out at indicatorwebinar.com. 100% free, my gift to you. And also, before you leave, go ahead and subscribe to the channel so you get more videos like this. You'll be notified when I put out new videos like this 2 to 3 times every week.